A few years ago, I started to write down a list of my own observations about capital markets and how best to navigate them. This comes after 3 decades of longevity in the business, including millions of miles of air travel, countless company management meetings, investment conferences, and individual decisions. Hopefully, in all these big and little moments, I've learned a few things that can be applied to improve the odds a bit. The business of investment management requires portfolio managers and investment analysts to make accurate observations about the world, industry conditions, and how they may be expected to evolve in the future. Predicting the future and then predicting how people will react to it is an impossibly inexact activity. However, with the benefit of experience, you can at least see some consistent themes, and this was my starting point. My list of observations wound up turning into 2 lists. The first is a list of general tendencies that appear to be true a lot more often than they are false, but there will be exceptions here and there. These are helpful to keep in mind as one thinks about stocks to buy or steer clear of. The second list are more universal characteristics of markets, stocks, the economy, and businesses. It's worth pointing out that universal truths are hard to come by. You only need to identify a single clear exception to a universal thesis for it to be invalidated. So, as I have tried to compile this list, there are exceptions that may yet emerge. That said, so far I have yet to see any exceptions to these observations. So let's start with the general tendencies. Number 1, a lot of capitalism happens on the margin. This means that incremental customers, capital spending, or costs of financing can make a rather large difference over time. Operating leverage is a powerful force in most businesses. Number 2, forecasts about the future tend to tell you more about the forecaster than they do about the future. I've become very cynical about economic forecasting and especially market strategists. Most of these characters have predispositions to blanket optimism or pessimism, and it tends to show through in their work. Number 3, the economy makes for good dinner party conversation. Your thoughts about the economy will not help you pick stocks very well. This is a good way of saying that the market tends to reflect prevailing economic wisdom, and you're not going to get very far buying risk assets because you think the economy will be good or bad. Number 4, the 10 times earnings theorem. Over time, one should buy a stock only if it can make at least 10% of your projected market value in the future. It won't make much money for you if this isn't true. This is a theory I came up with a few years ago. Whether you're buying a cheap industrial company or a high-growth technology business, if the company has a market value of, for example, $10 billion, you need to believe it will eventually earn at least $1 billion and be able to sustain this earnings power. Maybe not next year and maybe not for a few years, but eventually it needs to do this. Today's growth darlings will mature and slow down. They had better be able to support their valuations. Number 5. Buying stocks with high free cash flow yields or a low free cash flow multiple is superior to all other forms of value-based investing. I've looked at many different definitions of value to justify upside potential. A high free cash flow yield at the point of purchase works far more reliably than all the others. Number 6. Good values don't come in a box with a ribbon on top. They tend to have visible flaws. Speaking of good values, they are seldom devoid of weaknesses. The goal is to identify a transitory weakness in an otherwise strong business. The cardinal mistake is to try to rationalize away structural problems in a business in the name of a good purchase price. Number 7. Find the areas of the market with the highest earnings growth. In a given year, these stocks will tend to outperform. Most investors love earnings growth and hate year-over-year declines more than they would ever care to admit. If you can beat them to the spot and identify earnings growth early on, your stocks tend to do well. Number 8. More money has been lost chasing incremental yields than in everything else put together. The equity markets are not nearly as large as the credit markets. Just like equity investors love earnings growth, fixed income investors love higher yields. The problem is when they get greedy and start chasing yields. Ultimately, these episodes end very badly. It's important to spot dangerous yield-seeking behaviors early on and steer clear. Number 9. American capitalism works. I've often wondered why the U.S. economy is so potent despite its own visible flaws. It's our system of American capitalism. There are 3 distinct features. The first is we let prices fully express themselves. Second, the government is not involved in for-profit commerce. And third, it is very difficult to change laws. If you put these three features together, it lets people with good ideas and good business skills really have at it, with big rewards for success and big incentives for competitors as well. The rules of the game are stable and predictable, so you can plan many years into the future. There are very few other countries in the world that have this combination of features. Now, onto my list of universal truths. The first is that capitalism tends to create extreme winners. The system of private enterprise, competitive free markets, intellectual property protection, stable laws, and government restraint from engaging in business is an overwhelming driver of prosperity. But unlike sports leagues or intellectual competitions, competition in the marketplace and in a properly managed free market system can create individual corporate winners that are so overwhelming that populists, politicians, and even the most well-meaning have difficulty accepting the fairness of the results. There are no draft lottery picks or limits to the hours of the day to bound outcomes. Ultimately, many governments and peoples have a difficult time accepting these tendencies. Though capitalism is supposed to create huge winners, even the most successful businesses can fail to evolve. The downside tends to come from within. Arrogance, greed, cultural stagnation, and of course competition can rebalance the scales. Number 2, digitalization is total. Once a physical or analog realm begins to be digitized, the process tends to be irreversible. Digitalization is uniquely deflationary and very difficult to compete against. Betting against digitalization tends to be very unproductive. Number 3, the Malthusian thesis tends to look right from time to time, but is yet to be correct. Scary warnings of pending shortages of vital resources and materials have plagued our consciousnesses frequently. But these warnings presume that technologies don't advance and that human beings cannot adapt their environment or activities to cope with changing costs. Ultimately, we don't have to use any particular material or resource except food, and this is easily made. Number 4, there is no limit to the human mind, but there are plenty of limits to the body. This is why the Malthusian thesis is not true. Number 5, the conservation of risk. Risk is neither created nor destroyed in a complete financial system, but tends to move from one location to the other. This looks and sounds almost identical to the first law of thermodynamics, and that is very much the intent. For financial people, this is likely to be the most provocative of my observations. The point is that risk takes many forms and cannot be exiled from financial systems or investment portfolios, despite vigorous attempts through financial engineering and complicated portfolio construction methods. I believe that at the root of all financial crashes and associated calamities lies some failure to understand this basic observation. Often, the financial conditions that create risk are stored like potential energy and released like kinetic energy into securities markets. This process resembles a ledge of accumulating snow that is eventually released in an avalanche, or the geologic energy in tectonic plates that's released in an earthquake. But risk has many definitions in capital markets: volatility, loss of principal, systemic or cross-asset class factors, and liquidity, just to name some of the more common forms. There can be episodes of risk building and risk being released, where after the episode is concluded, financial conditions become more constructive. These calms after the storm may be just illusions as risks are transferred out of one asset class and into another. It would be seductive to believe that after a major risk episode that some sort of symmetrical calm will follow. I just don't believe that this is actually true. Number 6, bad old ideas and ideologies don't die easily. They tend to be reincarnated. In the world of finance, some truly bad ideas include generating growth through financial engineering, the notion that a certain asset class always generates superior returns, or third, there exists some kind of unique financial recipe that generates returns irrespective of what the markets do. Hopefully the listener knows a little bit what I'm talking about. I put these financial ideas in the same box as political ideas, such as totalitarianism, conspiracy theories, and utopias. Somehow totalitarianism was supposed to end with the Cold War, but did not. Somehow conspiracy theories that a small segment of the population has a vague, devious, and undisclosed plan to control the world resurface from time to time. Utopian theories that governments can and should control certain means of production and innovation to achieve, quote, just goals that are different from what free markets would otherwise render become intellectually fashionable. It's shocking to me that these financial theories and these political theories can't manage to stay dead for very long. Surprisingly, they don't, and it's worth making note of this. Number 7, it really helps in business to know exactly what you are trying to do. It helps exclude a lot of lesser possibilities. Number 8, the correct attunement of a masterful investment manager tends to change every few years. To stay successful, every few years as an investment manager, you should expect your attunement to be challenged. A lot of promising financial careers have come crashing to a halt when managers cannot make these adjustments.